Good afternoon. I'm Damon Southward, scalp trader. Joining me today is Brett Manning, who goes by the handle Chart Trader. He's one of our top traders here. Thanks for joining me today, and hopefully this webinar will provide some value to you. All right, so the topic today for me is one-trick ponies make good glue. And the point here is that I know a lot of people are coming back to the markets who haven't been involved in 5, 10 years, maybe not since the internet bubble. And back then, people were able to come in, scalp trade all day, and possibly do pretty well. Well, I'm here to tell you the world's changed. If you're going to scalp trade all day, you might as well give it up right now. Now, what works is, I think, having a multi-strategy approach. And if you're focused on scalp trading, the reality is that during certain portions of the market, trading conditions just are not going to be ideal for you. So either you're sitting on the sideline for that period of time, or you're remaining active and losing money because you're forcing trades in choppy conditions. And with all the high-frequency trading that's going on, and just periods of time where price action becomes relatively random in equities, day trading in a weak, choppy environment is a sure way to losses. So just to give you an example of what I consider multi-strategy, this year, the areas that I'm personally making money are in distressed, microcaps, pink sheets, momentum, and leveraged yield. And so you're talking about 5 different strategies here that I've thoroughly researched, that I've spent a lot of time getting my arms around, and it gives me the ability to be flexible. One thing might be working at one portion of the year or one portion of the month or one portion of the quarter. Other things might be working at other times. So by knowing different strategies and being able to exercise different strategies, you're always actively involved in the markets and you have opportunities available to you. Last year, I made money in distressed, yield, and IPOs in the first half of the year, and small caps in the second half, small cap momentum. And second half of the year, small cap momentum is the only thing I really made money in, but it covered, it did really well. It did really well. So at that point in time, usually I find that there are 2 or 3 strategies that are working at one point, at some point in the market, and but sometimes there may be only one. Intro to distressed trading. Well, one of my favorite trades over the past few years has been trading the high short interest distressed name. So essentially what you're looking at is a prominently known name that everyone knows is going to go bankrupt. The balance sheet is in such terrible shape that a $2 or $3 stock with maybe $2-3 billion in debt, with a good portion of that coming due within the next few months, is not going to be able to be refinanced. You have a lot of vultures out there who will go in and short that stock because they know eventually it's probably going to go to zero. And so if they can short it at $2 or $3 and catch a quick ride ahead of the default down to, say, 20 cents, they've made 90% on their money pretty quickly. Now, often what you see, though, is that on that initial move, the day that the company's filed for bankruptcy, you get a major short squeeze in that stock. And we've seen that play out in a number of names last year. I know we were involved in STP, for example. I think we caught that at 30 cents and wrote it up to 50 cents in maybe an hour. I think by the end of the day, it was up at 70 cents. So that's just an example of a short squeeze on a bankruptcy play that people knew that was coming. Shorts were heavily involved in it. And it was a nice short squeeze play for over 100%. I think that stock eventually went to maybe $1.50, $1.60 before it came back in. In terms of playing distressed names for upside, what you ideally want to see is companies with hard assets, planes, ships, real estate. And so when I say upside, I mean situations where a company files for bankruptcy, but there might be a chance there could be some equity value left. If you're around with us last year, you saw that we're active in American Airlines. At one point, I think that stock was trading at 30 cents and eventually went to $11 or $12. Situation where There were assets, hard assets that could be valued. The company was being turned around, and there was something left for shareholders. Right now, Fannie and Freddie are considered those plays. I'm active in both of those stocks and the preferreds, and we've been very active on those names over the past year. So we'll see how that plays out. But you want companies, in terms of the turnaround situation, that you're speculating in for the long term to have hard assets. The biggest one that I can recall is General Growth Properties a few years ago. I remember buying that literally at 27 cents. I think the low of the day was 25 cents on the day they filed for bankruptcy. Man, that stock's trading at about $20 now. Another point to note is that the bonds can be more attractive than the stock over the long term. So if you're looking at those companies with the hard assets that can reasonably be turned around, that have some underlying value, at the end of the day, in 95% of the situations, the equity is going to be wiped out. There may be some trading opportunities and volatility in the equities over the 1 or 2 years that a company works through the bankruptcy process, but eventually that equity is most likely going to be wiped out. And the bondholders are going to end up with the new equity in the company as well as new bonds. So, for example, a recent example is OSIGQ, the company. Well, both the common and the fixed income have some value, but the bondholders have been able to realize a gain of 200–300% just over the past, say, 6 to 9 months, and they're going to get new equity in the new enterprise. So some of the examples of distressed opportunities in 2013. Fannie Mae rallied from 30 cents to $5.44 in 2013. Freddie Mac from 29 cents to $5. OSGIQ from $1.10 to $8.75. But here's the fixed income side of the distressed trade. Fannie Mae preferreds went from $1.90 to $10.40. It's not as big of a gain, percentage gain, but it was the safer trade. Actually, I got an email just probably about an hour ago from a customer of ours saying that he was still in one of the Fannie Mae preferreds that I highlighted last year. He bought it at $3, and today it closed at $12. And he was just asking me what I was doing with it, and I told him I'm still sitting on my positions of both the preferreds and the common. Preferreds are breaking out to, I think, 5-year highs today. The common is breaking out to about 2-year highs. So those positions are doing really well. On the OSGIQ bonds in 2013, they rose from $38 to $10 over par. Now I'm going to move on to momentum trading. This is another one of the strategies that I employ. And a lot of people love momentum stocks, and they're getting in because of the hype associated with the name, but don't really have a strategy other than, I hope this thing keeps going up. But oftentimes with these stocks, you'll see a 15, 20, 25% shakeout. And those late momentum players get nervous and they blow the stock out. So one of the strategies that I use, because I've seen this happen so many years, I've been doing this since 1996, so I kind of understand a lot of the rules of the game at this point. I'd say there are probably 4 or 5 names per week that I see hyped as the next big momentum play. Well, instead of jumping on all of those names, because most of them aren't going to pan out, you're going to lose money trying to play the breakout, I like to sit back, watch the breakout occur, and it's okay that I missed it, because I know it's going to come back at some point. You're usually going to get a 25–30% correction in these stocks. And most people, once they see a stock get hit 25–30%, they think, oh, the move's over. Well, for me, that's the time that I'm starting to look at the name, because especially if it's a high short interest name, I consider high short interest anything above 15%, and something with a low float that is mainly being driven lower by concerns about valuation. You know, one thing I've learned over the years is that valuation means very little in the momentum space. I mean, it's actually kind of a catalyst because valuation is something that attracts shorts in droves. And so stocks with high valuations, the Netflixes, the Teslas of the world, I mean, those are the names that really go because shorts can't come up with a rationale for why these stocks are trading so high. And they're aggressively shorting them. And any type of catalyst will propel these stocks 10, 15, 20% in a day. Just as you saw with Zulily today, it was up, I think, 40% on earnings. There was concerns that they were going to have a disappointing quarter. A lot of people were short into the report, and the stock just really took off. So the strategy I use with momentum names is that instead of trying to chase the breakout, which is the downfall of many a trader that I've seen, I basically collect a list of momentum names that I like, and I sit there and patiently wait for a 25 to 30% pullback. And during that process, I mean, once you're down 10, 15%, I really start doing an extra level of research so that I know if I really want to position in these names. And a lot of times, say like a Solar City, for example, there are moving parts to the story that the average investor or trader just isn't aware of. And so if you can find that moving part, that compelling catalyst that's going to drive the story higher that isn't apparent on the surface, I mean, that's where you find the really big winners, because shorts are banking on these things all the way down thinking, oh, it's overvalued, it's overvalued. Sometimes they just don't really know the true story. So here's an example of Solar City. As you can see, off the pullback, off the run into October, it had about a 33% pullback over a 3-week period. Now, stock had a nice little run up into the $60 area or so, which is fine. I mean, you're not going to always catch the initial move. You know, you can speculate and try to find the next Solar City, but, I mean, this is 1 in 500 stocks or 1 in 1,000 stocks is going to do something like this. So I just think the odds are better at playing that pullback move and catching the second leg of the extension. And as you can see, I mean, Solar City closed, I think, 82, 83 bucks today. You could have bought it in the 40s a few months ago and caught a double there. Okay, another strategy that I employ is the relative value approach. So I'm a big relative value guy. When I see a theme-based momentum move, then I typically know, I usually expect secondary plays to follow suit. So, you know, rising tide lifts all boats. So if I see something like a social media or China or specialty retail, momentum money getting behind those industries, those spaces, then I start looking for names that are similar that have lower valuations on the expectation that money will eventually trickle down to those stocks. And so instead of, you know, speculating on the primary name and not knowing if I'm late, if it's truly really an extension opportunity from here, I go to the secondary and tertiary names and, you know, look for something that's cheap, that's very similar to that momentum leader. One current example is Blue Mobile, which I have a swing long on the site. Zynga has been breaking out, and you haven't seen this type of price action in Zynga in a while. And I looked at the valuation. Zynga's trading at 3.35 times EV to sales, while Blue Mobile is trading at 1.96 times EV to sales. Personally, I think Blue Mobile has a better story going at the moment in terms of its ability to deliver upside and extend on its momentum move. So I've started scaling into Blue Mobile on the anticipation of just momentum money picking up Zynga, momentum money flowing into social media and gaming stocks, and eventually Blue Mobile finding a strong bid. At some point, you oftentimes will see the secondary or tertiary names take over the leadership position, especially if they're stocks that are starting out under $10. And they have the ability to move from, say, $5 to $15 or $20, whereas the primary name may move 75%, 60, 75%. So that's another reason I like looking further down the the list of names, because those stocks under 10 can often have the bigger performance. All right, so that's the overview of some of the strategies that I utilize on a daily basis. I guess the one thing that I'll leave you with is that this is a very different market than it was 5 or 10 years ago, and that you really have to employ a multi-strategy approach to be successful. I mean, I look at myself today. I had just a phenomenal day, but 85% of my profits came on swing positions. 10 years ago, I would never take a stock home overnight, and so that's been a big change for me. So, you know, this week, just in terms of the types of things I've traded, I mean, I'm an aggressive owner of Freddie Mac, Fannie and Freddie preferreds, have some biotech IPOs that in one in particular, EGRX, I have a swing long on the side. It did really well today. Have some BlackBerry as a speculative play, speculative turnaround play. And, you know, just a variety of things that different strategies, different names. Have the Glue Mobile, for example, as my relative value play right now. You know, there's just so many ways to make money in this market, and scalping really is probably, I'd say, the least attractive of all the strategies that are out there. And I think Briefing does a very good job, Briefing Trader does a very good job of helping you understand the various strategies, doing the research, the heavy lifting for you, and presenting the information so that you can find the opportunities and participate in the opportunities. We have a team of analysts, dozens of analysts in here doing the heavy lifting for you so that you don't necessarily have to get your hands as dirty. But again, it's a very different world, requires a lot of research and effort, but it can be extremely rewarding. All right, well, thanks a lot, and I'm going to pass it along to Brett.
Okay, thanks a lot, Damon. Hi, guys. My name is Brett Manning. I post under the chart and ETFXX tickers. I've been actively involved in markets for about 15 years. And first of all, one thing I can do is definitely echo a lot of Damon's sentiments about the need for making adaptation. For me, probably over the last 6 to 8 years, the primary adaptation that I've made is to evolve into a mostly macro side trader, because what I've done, instead of looking for individual stocks a lot of times, is look for really big markets that are moving a lot, because I tend to find better profits from looking from a top-down direction, whereas Damon finds things by being creative and looking from a bottom-up direction. But again, I used to scalp an awful lot, and I've had to make an adaptation, but in the opposite direction. So there's a ton that I'd like to say on this subject, just taking a macro perspective on trading in general, but we only have about a half an hour, maybe a little less. So this will be a rather brief introduction. Slide. Okay, again, it's interesting to pair this with what Damon was just covering, because his focus is very bottom-up. And I'm going to try to give you something helpful from the exact other direction, looking at the markets from a top-down perspective. Looking at the markets that way, the whole financial world is sort of like a great big jigsaw puzzle in terms of how assets all fit together. The point I want to make today is that it's really important and really helpful if you can maintain a top-down perspective on what's going on all around the world on that big jigsaw puzzle in real time and across time. That awareness will allow for a lot of crucial inferences that you wouldn't be able to make otherwise, just getting that perspective. And I want to discuss a few important examples of dynamics that are going on right now and how I go about kind of matching things up and pairing things together and looking for opportunities at the end. But before we go further, I want to digress just a little bit to kind of set the stage. And it's going to seem like a wild digression, but really it does make sense. A couple thousand years ago, there was a guy named Ptolemy, and he came out and said that the Earth was the center of the universe. 1,500 years later, there's a guy named Copernicus who said that the sun was the center of the universe, and now Copernicus is generally considered as correct, as everybody knows. But I want to take the position that both were wrong, and both were right just about as much, because everything in the universe is moving relative to everything else. And if you go to any point, you can pretend that it's fixed, and the universe will move around it in a certain set of laws of motion from the perspective of that fixed point. Okay, you can take any spot as a fixed point of reference, and you can assemble a model from that perspective. Macro trading and analysis requires basically the same kind of angle on things. Every market really only has any value at all when it's taken as relative to every other major market and the financial system as a whole. And all of your insights that are going to be really important from a macro standpoint have to come from that kind of worldview. If you start to look at something as having an absolute value, and there'd be nothing else that you need to concentrate on to understand what that value is made of, then you're going to get killed for reasons you have absolutely no idea or don't understand at all. So the whole thing's interconnected. It's one universe of money. And there's a lot of conclusions and inferences that can be made by taking the point of perspective, pretending that one or the other asset is the center of that universe, and getting acquainted with the relative tendencies of that movement of everything else relative to that market from that point of view over time. Slide. So before I go a little bit further in that direction, I want to really quickly show how I watch everything. So this is my basic setup right here. I use a 5-screen setup, and 3 screens on the bottom, all market data. The other 2 on the top, I generally have briefing tool in play on the left-hand side, the miscellaneous one on the right-hand side. And one thing that's usually up there on the right-hand side at all times, well, not at all times, but a lot of the time, is the briefing feedback page in my email. And I'm constantly checking those, so I can promise you that if you want to talk to me during the day, you want to get in touch with me about something, just send it to our feedback, send it to my email, and you'll get a response. Slide. Okay, and you can just scroll through these 3, Damon. The bottom 3 monitors, you can see the screen 1 and screen 2 and screen 3. Slide. And now just one more time, slide. I'll focus on each one now. So the bottom left is kind of the top-down, constant monitor of things, and I change what's there exactly. But right now, I have the S&P futures, the NASDAQ futures, crude oil, gold, financial sector, the euro, T-bonds, and copper. A lot of times I put the Nikkei up there, the yen. I like to constantly watch the yen, and sometimes I've actually started to fill out some of my 4th monitor above with some other markets. But having this sense of watching everything in real time and seeing it in the context of its longer-term patterns is really important. Slide. And the middle screen is a more focused market, whatever I choose to focus on specifically that I'm watching in the context of all of those other markets. I have a larger time frame chart, daily, weekly, and what I call a scrunched interval chart, which is the one that's on the top right in that expanded image. And that's usually at 30 or 60 or 90 minutes. And that may be the most important chart of anything that I look at because it allows me to see the intraday extremes of movement inside of the larger time frame pattern. Without losing perspective on the trend, you can look at the interior pattern. And again, all of this comes in context of looking at that screen we looked at a moment ago, where you see what some particular asset is doing in the context of all of those other assets. Slide. Now the right monitor is where I have the really close intraday focus, short-term time frame, 1, 3, 5-minute chart, and it's linked to quote boards where I have a one-click function where I can load the short intraday, the long intraday, the daily, and the weekly all on whatever ticker I click on. The bottom quote board is all a sort of universe of constant watch list stocks organized by sector, the discretionary tech industrials to the left, metals and energies in the middle, transports, financials to the right. And then up the right side is all macro, commodities, currencies, bonds, volatility, and equity index futures. So I linked them all together. I'm constantly watching these. Slide. That's a setup that's evolved into place over the course of about a decade when I started using it. And it's pretty much gotten fixed in place over the last 5 or 6 years. And I really do recommend something like this if you can accomplish it, because it allows you to see the world of assets, that giant jigsaw puzzle, always in motion, and whatever you're looking at in the context of that, and to be able to really quickly scroll through whatever you're focused on trading. So it's this sense, once again, I'd like to reinforce of constantly having perspective on things rather than just attempting to look at something in a vacuum. Slide. Now from here we're going to get into some more complex advanced material, and I just want to say right off the bat that if you're not familiar with something, just write it down, and you can get in touch with me after the webinar today or tomorrow or whenever, and we can chat about it, we can discuss it over email, whatever, but just make a note of it. Okay, slide. Now, this isn't a perfect system, but one of the most important dichotomies to me when taking a position or generating my bias, what I'm interested in, what I believe that I can accomplish in a particular environment, setting my expectations, is I usually start with the VIX as a general measure of volatility, because the VIX usually responds to more than just the equities market. Just generally speaking, there are other measures that I use as well, but I'm going to try to keep it a little simple and just stick with the VIX for this. And roughly speaking, when markets are more volatile, and I'm going to say above, say, a 2250 in the VIX, I get more aggressive, and I focus exclusively on futures trading. That's what I prefer. That's when I actually end up over the course of the year making the lion's share of what I take in. That's a situation where the largest possible markets are moving enough to really make something. And that's the best possible world. Something that harkens back to something Damon was talking about, where you've got different forces that are involved in markets at a really efficient level, creating a lot of size with how cheap margin is at this point. The bots and everything else that get in there, they're really going to have a tough time moving around a market that's moving billions of dollars a second in a gigantically volatile futures market. You get run over and the crowd takes over, and that's when I kind of consider the term "the music is playing" to really be there. When the music is playing to me is when the VIX is up, and I get more aggressive and I expand to bigger markets. When the VIX is lower, like it is at this point and like it has been for most of the last few months, I tend to focus a bit more on individual stocks, usually large caps, and I do a little less size and I'm a little bit less aggressive. So that's, those are two worlds to me. And in the middle there is obviously a transition. It can go either way, and it depends on some other things. But there's this kind of way of separating environments into two sort of distinct areas that shift the way that I behave. And I found that to be extremely useful to be able to look at the world and segment it that way and not get overly aggressive in a quiet market, because there's a lot of things that can happen that really have no meaning. And you can't really depend upon your conclusions quite as much. Okay, slide. And what I focus on trading from a macro perspective is, well, just about everything at this point. I trade stocks, currencies, commodities, bonds. In the stock market, I trade mostly individual, highly liquid and volatile large caps, Apple, Netflix, Tesla, etc. And I will go across sectors, and I will move to anything, but I really don't, generally speaking, do not do much in small caps or micro caps, because, again, I generally, the way that I've evolved as a trader is I don't tend toward a bottom-up perspective, and that's what you really would need to have. But I do even more volume, however, in terms of equities in the S&P futures, the NASDAQ 100 futures, the Dow futures, and the Nikkei futures. I don't do as much in small cap futures either. It's just a tendency that's developed over time. In the commodities complex, I do a lot of activity in crude oil, gold, silver, copper, and nat gas, although less in nat gas, because I found that market to be more lumpy. Right now it's not. It's extremely liquid and volatile, but a lumpy commodities market simply means a market that's controlled by a few very large players, and it's much more difficult to draw conclusions you can have conviction in a situation like that, because you're down to reading some individual's mind sitting in an office somewhere rather than reading the behavior of a market. In the currency futures, the euro, the yen, the pound, and the Aussie is a pretty stable mix. Sometimes the euro, yen, and I used to trade the Canadian dollar, and I just found that that's the one currency that somehow, for some reason, I've just never been able to make anything in. I have no idea why. It's just worked out that way, so I just leave it out. So if you see me posting currency plays, it's probably going to be the euro, the yen, the pound, and the Aussie, with the euro and the yen being the forefront there. And in bonds, I basically just stick to Treasury futures at the long end of the curve, 10 years, 30 years. And again, mostly in the futures market. A lot of times I post these trades in an ETF, and I'll do that when I feel like it's a play that people who don't trade futures can easily take advantage of and profit from. The copper short that we had the other day was not posted with an ETF, because really there's no good ETF to trade for copper. So when you see me post exclusively futures, it's usually that. Or alternatively, if it's an extremely fast-moving market, I'm not going to have time to be able to post in both. So you'll just see the futures or you'll just see the ETF. Okay, slide. All right, now the first concept I want to cover before we get into specific macro trends that are going on right now is something that founds basically everything that I do in my approach to markets. It's what I lean on as one of the primary bases from me having an idea or a bias in a market with conviction, and that's sentiment data. concept of looking at sentiment data. It adds an extra dimension to what you're analyzing. You can analyze the fundamentals of something, you can analyze the behavior of that market, but when you're analyzing sentiment data, what you're doing is actually getting to the most important factor, which is how people feel about that data and that market. And in the end, the most important thing about a market is not its fundamentals of supply and demand as much as it is how people are positioned relative to that, because that's what indicates whether or not something that you can, deductively or syllogistically conclude about something is priced in or not. I mean, people, when everybody gets the same idea at the same time, that market is going to be pricing to an extreme value of that idea. So the way to interpret sentiment data is not, what I found is just a terrible job in most of the mainstream financial media that I have seen in terms of really encapsulating the important conclusions here. You'll see pieces occasionally on like CNBC about sentiment data. And a lot of people will discuss the idea that when sentiment is improving, that's a real positive for markets. And it's a spectrum. It's important when it's improving from an extraordinarily low level, but when it's middle of the road, it really doesn't matter what it's doing. The important thing with sentiment data is all about extremes. And that springs from an individual case-by-case analysis of how that sentiment data comes. Right? When somebody's bullish on something, it generally indicates that they own it. It's the reverse of what most people think. And there's been some studies done on this. People come to get greater commitment to an idea after they've already made a financial commitment to that idea. That's when people start to talk about how great an investment something is. It's after they buy it. And the moment that they actually pull the trigger and buy it, they're usually very uncertain. And if you really search your feelings about trades that you've made and investments that you've made, you probably think and realize the same conclusion is true about yourself. You're thinking about it, you're considering it, and then when you actually pull the trigger, you really start to argue in favor of it in your own mind. So sentiment data, my conclusion is, sentiment data basically conveys positioning. And positioning is the most important thing to figure out in a market. All right? With lots of people, then consensus becomes an important factor. When lots of people are all expecting the same thing, that thing, by definition, becomes basically impossible. When everybody's sitting long looking for something, the supply of potential buyers is exhausted. The only place that it can go is to unwind that extreme, which is the opposite direction. Slide. Now this topic, I covered this in a lot more detail in a webinar I did a couple years ago. I just want to point that out. If you can possibly take this down in this time, or I posted in my style guide. You can search the ticker style and go to chart, and you'll see the link. I do a lot of in-depth on pattern analysis and sentiment data there. I don't really have time for that here. Slide. As far as quick run over the surveys and things that I use, the primary surveys I focus on, the American Association of Individual Investors, Investors Intelligence, and Hulbert. I use a lot of options data, but specifically the robo ratio and the lobo ratio. These are the retail-only buy-to-open ratio. In other words, smaller traders opening positions in options trades. And that's really useful because what you're looking at usually is home run bets. It's not put protection, things like that. It's somebody taking a small amount of capital and trying to make a ton with it. And when a lot of people do the same thing, stepping into a leveraged market with a small account, it indicates something. When you have an extreme in the robo ratio, that means you have a consensus of people trying to do this. When there's a consensus of people trying to hit grand slams with small accounts, you have a very strong indication of what the general sentiment for that market is. And it's a speculative extreme. And it's ready to unwind. And the robo ratio is invaluable that way. RIDEX fund flows data is also really important, though maybe becoming slightly less so. However, it's given a lot of good indications lately. The RIDEX has funds that people can invest in and quickly move money around in. And they have bull funds and bear funds. And all you have to do is look at the amount of assets in the bull fund versus the amount of assets in the bear fund, and you get a sense of how people are speculating. Sentimentrader.com, I can give that shout out here. I've used it for years, and it's just a very good place to find a summary of lots of sentiment data. So I'd encourage you to check that out as well. Slide. An example of that is the market top we just saw in January. We bounced back from that in a kind of historically rapid way. But it's still a good example of how this worked out. Started writing about the sentiment data problem in December. I put a few pieces up basically saying that we were starting to hit some extremes. The extremes got really crazy in mid-January, and then we got a bear catalyst when the emerging market weakness appeared. And we're going to go into that in just a moment as far as what really happened there. But As far as the form of a market top and a pullback, this is a really kind of typical form for it to take. It's like a fruit that gets really ripe and then it falls off the tree. And the sentiment data is the indication the fruit is getting really ripe, right? And when you have a market that looks like it's maybe toppy, you got to check that sentiment data because you may have a situation where the fruit is not at all ripe. You know, there's not at all that much of a speculative frenzy going on. There's just money consistently coming in. It's a market that's probably headed much higher. But in January, we had definite extremes. And you've got to really get both the, get the pattern and the sentiment data ripening and then the catalyst. And you really kind of had that typical form. So I'd encourage that model of thought. Slide. And here's the sort of chart record of that. I wrote about these pieces in the ETF daily notes as each one happened. We got the surveys hitting multi-year bullish extremes in early December, and they held up there. And then the RIDEX ratio registered it in late December with everybody stacked up all the assets in the bull fund to the greatest level in more than a decade. And then finally the Robo ratio when all of the small traders started to take home run bets on breakouts in individual stocks. All of that added up, and then we got, as you can see, the red line, the red sloped line there, when we got that trend line that was tested 5 times, when it turned and broke, at the same time as we started to get the emerging markets falling over, we got the big slam down. Slide. On January 2nd, I wrote about this, kind of setting the stage for this sort of thing because you could see it in advance. You could kind of see this developing ahead of time. I was wearing my contrarian hat based on sentiment data, and basically this lets you know that the fruit was ripe. And I put that up on the page, and as you could see, the breakdown in emerging markets was the boogeyman, and we began posting short trades in the S&P about mid-month, and we made some nice profits there. Slide. Okay, now I want to get into just a couple key macro dynamics that I think are really defining the context right now in the world that are important to understand if you start to take this sense with you out of this webinar and try to apply a little bit of that thinking of the giant jigsaw puzzle so you have perspective on things. A couple of dynamics right now that are really defining things a little bit under the surface as individual equities break out. One of the main ones is the flight from emerging markets that we saw that really was the catalyst for that pullback. And the important thing to understand about this one, and it really serves as a good example of the kind of Ptolemy versus Copernicus kind of view of things and realizing everything is relative. When central bank reserves are shrinking, right, so the Fed started to taper QE, as we know, and they started to mention that actually in late May of 2013, and that's really when the emerging market problem started. And just as a general rule, when central bank reserves start to shrink, there's always a risk of a crisis of confidence in foreign investment in countries that are running large current account deficits or attempting to defend fixed exchange rates, especially smaller economies. In either of those cases, you have a system that depends upon expanding liquidity around the world to allow for the locals to sustainably keep borrowing in a foreign currency, and that's really what the problem is. And that's why we saw the whole group of liquidity-dependent emerging markets crash altogether. And it was them, and it was systemic. A lot of people tried to come up with an individual story for Argentina, and an individual story for Turkey, and an individual story for Indonesia. But it was, these 5, Argentina, Brazil, Turkey, South Africa, Indonesia, they were really the center of it. And they were all these running high current account deficits, several of them trying to peg to the dollar and borrowing in a foreign currency and trying to keep money flowing in, but it had to be dollars because that's what they owed, right? They didn't owe their own currency, or their currency declining a lot would have helped. When they start to see their currencies fall apart, suddenly what they owe goes to infinity, and everybody starts to pull everything out. And one of the important things about this type of situation is this points out a kind of law of the financial universe, which is that there are these cascades or feedback loops or self-reinforcing dynamics that emerge that can come and wipe you out on something when you don't even realize there's a relationship with, say, some individual stock that you own. But really you're getting caught up in a feedback loop or a cascade that's going on because of some financial dynamic, that's sort of coming down upon you from the macro world. And in this case, the self-reinforcing dynamic is concerns the short-term exploratory nature of foreign investment in emerging markets leads to this kind of fire in the movie theater type of reaction. And that depletion of the liquid resources feeds into other areas, the credit markets, the currency markets, the economic system. For some country like Turkey, that's a real problem that can set them back for years I mean, it's almost like if you could start a fire in a movie theater just by yelling the word fire. The emerging markets tend to act that way. And this sort of factor, the fact that a lot of the thing that was supporting them was money from Europe, money from the United States, sort of like going abroad as foreign exchange students. You know, when there's suddenly bad news in the foreign country, all the exchange students get pulled back to the homeland. And that's the same thing that happens with the money. And that sort of thing can really kill the emerging world, especially, like I said, for these special types of countries when you got general reserve bank liquidity kind of shrinking. Right? And so with the Fed tapering, that's exactly what we got. All right, so let's go to the next one slide. One other of the most important macro dynamics is something that we used to hear a lot about, but you guys probably don't hear much about right now. And so I just kind of want to put it out there again. Quickly cover the basics of it. It's the yen carry trade, or it's borrowed yen-funded leverage in other assets. And I promise you there's going to be times when you hear a lot about this again, because it's really gotten extreme again. It's not a huge issue right now in terms of manifest effects, but it's a huge issue in terms of a latent sense. And it always has the ability to become just about the most important factor of the financial world for like a day or two. If things start to go wrong, say in the Japanese government bond market, or if we just get a sudden spurt of volatility, particularly in Japan. So here's how it works. Japan has the biggest QE program in the world, right? Relative to its economy, way bigger than the U.S. QE program. It also has chronically the lowest interest rates. And it also has policymakers that are the most committed in the world to the idea of keeping their currency really weak. And what all that adds up to is a lot of these hedge funds, they go to Japan, they borrow a ton of yen, they convert it into other currencies like euros and dollars, and then they make bets on those on assets in those other currencies. And that includes everything. And that creates a huge vulnerability. And here's how that really works. Slide. Imagine if you held a position knowing that the only way to close out your exposure was to sell the asset and then to convert it back to another currency because the capital isn't yours. It's borrowed. It has to be paid back. Right? For anyone long other assets and borrowed yen, this is the situation. The cost of them keeping the position on is defined by the price of that exchange relationship. You know, it has to be paid back. So imagine how it would feel to see if you're sitting in that position, the position starts moving against you, and the other currency starts moving higher really fast while you're still in the trade. It's an enormous double whammy. And because everybody else is in the same position, which is the case right now, it's hugely pervasive in the financial system right now. Lots of people borrowing lots of yen and long things like even the S&P futures, long treasuries, long European debt, long emerging market debt, long all sorts of things, right? Long Portuguese debt, Spanish debt, Italian debt. All of these things, all these positions are funded by borrowed yen with the sort of sacrosanct assumption that Japan is not going to suddenly see inflation, suddenly stop doing QE, suddenly raise interest rates, et cetera. All probably good conclusions. But the important thing is where the currency goes. So put another way, let's say you owe 100 million yen, and that adds up to being about $1 million. $1 million is worth about 100 million yen. If the yen starts ripping, your dollars are going to be worth fewer and fewer yen. So the assets you're invested in on those borrowed yen starts falling apart at the same time, and other people are caught in the exact same situation, so everybody starts to panic back in before the pain gets too bad on both sides. You can face total wipeout about 5 times as fast as you can in a normal position. In other words, a fund can get margin called or wiped out completely really fast, overnight, even if they have a lot of capital. And there's so many funds in the world that are in this situation that you can get forced selling in things that don't seem to be related at all. So when you're sitting there someday and you're watching crude oil go down 8% in a day as the yen is up a ridiculous amount and the financial sector is getting beaten up and Japanese government bonds are getting killed, you'll know why that's happening now if you've listened closely to this and how it kind of pays to get this understanding of how these things all interrelate. So slide. So, you know, again, basic conclusion, Japanese policymakers, they end their QE campaign for whatever reason, you're going to see it, you're going to feel it, and it's going to have an enormous impact. And this is a good example of how, you know, there's this kind of jigsaw puzzle that's looming over everything and that has the ability to give you a ton of pain or a ton of profit. I mean, last spring, we caught 2,000 points short the Nikkei futures and another 300 ticks long the yen at the same time. and made a killing in 3 days. And basically, it was this conclusion and this understanding that armed that play. And there'll be some other things that I post on the site that are similar, but I just want to give you some background now. And again, if there's anything that you don't fully get, you can go ahead and email me and let me know. Slide. In addition to my trading calls, I just want to throw up there, I talk about a lot of these things in a couple of different columns. I'm the one who writes the ETF daily notes and the ETF chart book, or the macro picture. And I generally speaking, I come in each morning and I look at the world of markets from this top-down perspective, and I try to put 2 and 2 together, and actually post individual setups like the gold breakout long setup we had this morning, which worked out pretty nicely. I generally cover the markets, mostly sticking to what you saw on that screen with the S&P, the NASDAQ, crude oil, gold, silver, copper, the euro, the yen, the Nikkei, etc. And I expand that same thing a couple times a month in the chart book, which basically gets to longer-term themes on this. Slide. And just to round this out, there's one last point I want to make, which is a sort of philosophical message, really quickly. Over the last 15 years, in an abstract sense, probably the most important single idea that has worked to help me understand markets is to get rid of the idea of trying to make money by syllogisms or deductive conclusions. You're never going to make money by having more and more information about something, particularly when you're looking at the market from a macro standpoint. You're never going to be able to look at the crude oil market and do a deeper analysis of supply and demand of crude oil, a deeper analysis of the inventory data, and actually be able to get ahead of that market. It's not going to be a situation where you can say, I see premise A, I see premise B, I see premise C, therefore I can deductively conclude premise D, that market is a short. You'll be wrong. Induction is everything. You have to be willing to make leaps of logic, inferences, and probabilistic anticipation on good guesses. And you have to be willing to bet heavily with tight measured risk on something that's a good guess, on something where there's something missing from your argument, and you know that it's missing. You know that you don't know something important, but if it's true, it would make a market in such and such a situation. That plus sentiment data is really the way to get big, big positions that work out really well. Limit the losses and be willing to take an intuitive inference with large size and tight risk. So, slide. And like Damon, it's important to know that this service is fully interactive, and it's one of the things I don't think that people take advantage of enough. One of the main features you're paying for is to be able to use us as a resource. If there's something you don't understand or something you'd like to discuss, there's my email address. You can email the entire Briefing Trader team, or you can use the Talk to Us feature, and we do monitor it all the time. So thank you very much. Slide.
Okay, thanks, Brett. So we're going to jump into the Q&A, and if you have any questions, feel free to send it into the chat area. First question, what do you mean by induction, Brett?
I mean the ability to form a conclusion where you do not have a deductive path to that conclusion. You need to insert something. You need to add a premise that you do not have conclusively at hand. So I'm willing to make one assumption. Let's say I'm willing to assume that I find sentiment data that indicates the potential that a lot of people are leaning long the market. I don't know this, but I can see that there's a lot of reason that people will be bullish on things. And if I were to work just strictly deductively, I would conclude that the market is a long, because there's all sorts of factors that are suggesting that good things are happening. But if I also see something that indicates to me maybe it's a good guess that there's a lot of people already speculating a lot on the long side, then I have a sense that there's maybe an exhaustion there. So if I'm willing to take a big short in that situation, then once it starts to unwind, only then is everybody going to realize that they were sitting on a crowded bus, right? But you're only going to be able to deductively get to that conclusion after the fact. The market's already going to price in every syllogism around, okay? Every deductive conclusion you can get is basically the meaning of the efficient markets hypothesis, which obviously I don't take in a literal sense, but I mean, that's how it works out. If there's publicly available information that will clearly define something as knowledge, then it's not really going to help you in getting an edge, especially on a big liquid market. Now, with a microcap stock or something, that doesn't really apply. But from a macro standpoint, it does. With a microcap stock, it may just be a lack of awareness. People just don't know about the company enough, and you can go ahead and look through their financial data and see that they're doing really well and see that it's a good investment. And you can buy it and make a lot of money. But from a top-down perspective, these markets are too liquid. You're not going to be able to achieve the same results in the S&P futures. You're going to have to make leaps of logic. So those are inductive conclusions, where there's actually a missing link in your argument, and you know that in advance, and you're still willing to take the bet on the assumption that your guess about that particular piece of information is right.
Okay. Next question, Brett. Someone wants to know how many trades in the ES do you make in a typical week?
How many trades in the ES?
Yes.
It depends on the week. Again, we go back to that VIX segmentation. If you have a VIX at 30, I'm going to be making 10 a day. I mean, if you've got a really liquid, really volatile market, I'll shrink down in terms of what I'm looking for overall, and I'll start to get extremely aggressive. My position size goes up by 5 to 10-fold in a situation like that. I mean, I will start to take extremely large positions. When we started to break down in mid-January, there were a few situations where I was trading, 10 or 12 times bigger than I would have on a day like today. And more frequently because I'm willing to get out and back in and out and back in something as I start to see the pattern evolving. Because in a situation like that, I can depend more upon how the pattern's working out. If I see something that feels to me like a rerun, like I've seen it 50 times over the course of the last 10 years, I can see a pattern developing. I can see a mode of behavior in the market that just, I know what's going to happen next. There may be a few shakeouts. There may be a headline or something that takes me out of that position, but I'm willing to get right back in and twice as big because it's dependable. The sense that that pattern is going to play out because there's big people caught in difficult positions that they have to unwind. And there's big people trying to move capital around. It's like a migration of elephants at that point. You can depend upon that next step. So I get bigger and more aggressive in a situation like that. But in a market like today, I see this overextended to the upside on a short-term basis, but I also see that a lot of money is coming into the market in general. The faucet is on. People are generally sliding their money into the market. So it's really tough to be aggressive on a day like today. Volatility is low. The market can't really go up any further right now, but it's got enough of a supportive bid that you're just going to get these choppy ranges. So it really depends upon the situation. Today I didn't do any.
Okay. Thanks, Brett. Someone is asking me, do I still think that high-frequency trading computers have made it much more difficult to scalp trade? I think that they're present, and it's important to be aware of their presence. And I guess the approach that I take is that on an average day in a name, say like a Netflix or a Tesla or a LinkedIn, one of the momentum names that a lot of people follow, the high-frequency trading programs are bouncing those things around without really a whole lot of logic or, you can't really get a sense of patterns. I mean, some of these things are programmed just to head fake you and to trick you. And so my focus on scalps tends to be on names that have news, some type of event, an event-driven catalyst that's bringing real money into that stock that day. It's not just some computer that's bouncing a name around because there's no catalyst to break it out of a range. It's just intraday chop, intraday noise that you really can't get your arms around. And the goal really is to just make as much money off of the day traders as possible by creating basically fake patterns or fake price action. So as you'll see, just as today, I had a couple trades in some momentum names that had news. When you get a lot of capital flowing into a name on an intraday basis, I just think it creates a better opportunity to scalp trade rather than going head-to-head with the high-frequency trading programs on a stock that has nothing going on in it that day. Next question. How do you interpret the relationships of various assets? I think that's for you, Brett.
How do I interpret them? I guess there's some certain ideas that I have that underlie it, assumptions that I make. I know the meaning of that asset is different. So it's not always just visually in terms of the patterns, if that's what you mean. I don't openly make correlations. I do notice that there are correlations, but I also understand certain things that I bring to the table, like understanding that there's almost, in an environment with low interest rates, there's almost certainly going to be an inverse relationship between the bond market and the stock market until you start to see a lot of growth picking up. There's also going to be almost certainly an inverse relationship between, say, the VIX ETFs and the S&P. But there's always going to be things shifting around, too. I mean, you do have to be willing to drop your assumptions in a lot of cases. Crude oil, for instance, will be correlated with the stock market when the price of crude oil is under a certain amount, because that's a growth indication. But when crude oil gets too high, it's going to start to become a problem for the equities market. So there's a certain threshold. And so when you see crude oil go past that threshold, you never know exactly what the number is, but it tells you something. The fact that it has gone past that threshold is an important piece of information. Suddenly, the market's starting to act inverse to crude oil once it's above 110. And that's probably the market drawing a conclusion about the meaning of, the actual cost of energy for production and what that's going to do to the economy. And that means that the environment is now a slightly different one. And there are lots of little things that shift like that, and you've got to constantly track. And yeah, the environment does change. And the correlations do change. So there's visual, but there's also some degree of basic knowledge. Hopefully that answers the question.
Okay. Someone wants to know, what's your estimated stop out as a loss percentage? Does it change from year to year? Well, on an intraday trade, I'm typically risking 4 to 5%, and I'm looking to make at least that. On a swing trade, my approach has changed over the past, I'd say, 3 or 4 years, whereas I go into most swing trades scaling in. I typically go in thirds, and I welcome a price decline so that I can average in at a better price. One of the things I've learned over the years is that usually you're not going to be accurate in terms of buying a stock at the exact price that it has bottomed and is beginning to extend. You're going to have to go in the hole a little bit. You're going to have to feel a little pain. And for me, having a full position on and seeing that stock down 10, 15% doesn't feel that great. And so my approach, and just my approach to swing trades has changed a lot, and it's actually helped me out quite a bit because I feel more comfortable entering a name with third position and then actually hoping for the price to decline so I can get in at better prices, and then I end up with bigger gains. And so I typically go in thirds. When I do a swing trade, it's a name that I've done a lot of research in. I feel very comfortable owning. So I'm happy to have the price come to me so that I can buy more of it at lower prices, and I typically end up with bigger gains. In terms of a stop out price, on those types of trades, I may risk 20%. And I may close them out a little bit earlier if something changed. If something changes fundamentally about the story, such as, say, an earnings report that indicates that business isn't going as well as hoped. And typically I don't own stocks in the earnings, so that's not a very common occurrence. But if there's some type of major shift in my underlying assumptions about that story, I'm willing to cut my losses and move on. But I guess since I've been swing trading, it's been very rare that I've actually had to take a loss on a scale-in position. Next question, Damon. I entered EGRX one quarter, added another quarter. I know this depends on price action. However, would you add in price if price goes up or wait? So this is a recent biotech IPO that I've been scaling into on the site, and personally, I had a big move today, so probably about 10, 12% in the money on the average position. I'm sitting on this one. I think it has higher prices, but it is a really choppy stock, so I could see it actually coming back down. I'll post an update based on the price action, but right now I'm sitting on what I have and trying to be patient with it. If I get a compelling entry price, I'll add some more to the position, but right now I'm going to sit with what I have and just let the position work. Okay, Brett, how do you interpret yen carry trade with S&P 500? For example, S&P 500 is at highs and yen is not.
Yeah, I mean, well, I suppose you mean in terms of the dollar-yen, right? So for everybody else, he's actually saying the yen is not at its lows in terms of the value of a yen to the dollar, I'm assuming. And that is really interesting. It's one of the really interesting things over the last 2-3 weeks is that, typically over the last few months anyways, and over the last really, well, the majority of the last few years, I guess, you're going to see the yen making lows while the S&P makes highs, and it's kind of this notion of nobody's nervous. And right now, the yen is actually holding up while the S&P is right at its highs, and it's kind of like if you saw the VIX holding up really well while the S&P was making highs, because it's kind of like the market is pushing higher, but there's still some nervousness in there. And what I would say is I'd have to interpret that as what it seems like face value, given the explanation that I just went through, which is that there are a lot of people who are in charge of a lot of money who have been expanding their capital to 20 to 1, 30 to 1 through borrowed yen, who are reducing their leverage or have reduced their leverage and are not putting it back on. And there's some other force in the market, in the world of equities, particularly in the United States, that's picking up the slack there. So if the market was originally running, say, a few months ago on the basis of hedge funds that were levering up their capital, now it's maybe running a bit more because of the re-entrance into the market of the retail investor. So you're having a less levered force that's not sitting there acting all on borrowed yen. And that would be a nice kind of, if they've got the money to do it, if it's not speculative, and if they're not levered up relative to some other debt they have, that would be a good thing for the market because it creates lowered vulnerability to something like a major problem in the Japanese government bond market. I can't see another great explanation for that other than, so people are sitting with lowered leverage right now, I would say is the face value conclusion.
Okay, this is an interesting question. Seems to me that when trading large blocks of shares and high volume stocks, the market makers know when you enter and do everything possible to shake you out. Am I just imagining this, or can it actually be so? My opinion is that yes, it could actually be so. And one of the things I tell people is be cognizant of the broker that you use. A lot of these brokers farm out their orders. They get paid for the order flow, and they're sending them to other venues, and such as hedge fund-owned venues. And I don't know how comfortable I am with that whole approach. I know a lot of our guys use interactive brokers, and one of the things I like about them is that they will give you the ability to use algorithms to enter and exit trades and to place stops. And one of the things that you often see, and I hear a lot of complaints about, is the stock came to exactly my stop price, blew me out, and then came right back. Well, one of the things I like about the programs that allow you to use algorithms is that you can structure it so that you don't get blown out of a stop unless the stock truly trades there. So a lot of times you'll see a stock come down and hit a price on 100 shares or a few hundred shares. Well, that would be enough to trigger your whole position, trigger you out of your entire position on a stop, even if you had 1,000, 2,000, 3,000 shares. So a stop, if your stop is at, say, 29.50, you may see 100 shares come down and trade at 29.50, then the stock come right back to, say, 29.60. You get filled there on most of your position, and maybe the stock rips right back to, say, 30.10 or 30.50. I see that happen all the time. So I think that's one thing you really want to be aware of when you're trading, is to be concerned about stops being triggered by just programs that are looking out there trying to run stops, and there aren't real trades. They're just out there looking for stops, and you want to make sure that you're dealing with a broker that gives you clean fills and entries and exits and allows you to place stop orders that kind of prevent you from being stopped out on bogus action.
Yeah, can I chime in on that too, Damon? There's just one thing I want to bring up. This is one of the very problems. It's the reason why I do a lot of trading from a macro perspective, because you're not vulnerable to that to nearly as great an extent when you're trading something like the S&P futures. And it's also, just because this will really drive the point home, why I said a few minutes ago that I'm willing to take trades at 10 times the size in a really liquid, really big moving market, right? When you've got a day where the market's doing huge volume on the exchanges, the futures are moving all over the place, you've really got a thick, big, giant market. None of that is ever a concern, so you can trade really big with tight stops and know that if that stop is hit, it's, you know, maybe you get a headline spike, but it's going to be something important probably if it moves up to get your stop. It's going to mean that you put your stop in at a particular place for a reason. It's because you have identified the setup from the standpoint of, I believe I can tell where I'm wrong if this doesn't work out. That's to me the definition of a good setup, when you get the sense that you know where you'll be wrong. And what Damon was just talking about is a violation of that feeling. And that's what's so frustrating about it, because you can't really quantify your risk. And when you can't really quantify your risk, and you believe that something that's just noise can end up moving past the point where you've designated as, I know where I'm wrong, then you really can't take much size in whatever it is. And if you want a big trade is only going to come when you've got a situation where you can quantify your risk, pick a point that you know you're wrong, and know that it's not going to be something random or noise that's going to end up taking you out. That's when you can get really big. So that's one of the reasons I trade more from a top-down standpoint in and of itself, besides the inferences we were talking about. And that's also the main reason why I get a lot bigger and more aggressive in a market that's really active, volatile, and high volume.
Okay, so that's the last question. Thank you for joining us today. Hopefully we were of some assistance and help. Feel free to contact us at thebriefingtrader@briefing.com, or contact me directly, Southward@briefing.com, or Brett at bmanning@briefing.com. And also feel free to reach out to us at any point on the Talk to Us feature on InPlay. We're always monitoring that, and we're happy to provide any type of assistance, any color, any guidance that you might need. Okay, well, thank you, and we'll see you on the trading desk tomorrow.
Thanks a lot, guys.